Welcome to lecture 6. In this lecture, I'll be speaking about inventory, a line item that goes into P&L statement in the form of COGS. So, the essence of this lecture will be an explanation of how inventory goes as COGS into P&L. To give that explanation, I'll be taking you through a block diagram step by step. So, imagine that at the end of the year, you are taking a stock of how things have been in case of inventory. So, you have purchased raw material worth $120,000. So, at the beginning of the year, you had zero raw material. But at the end of the year, you see and realize that $20,000 worth of raw materials are still with you. That indicates that $100,000 worth of inventory has gone into work in progress, right? Now comes the question that how are you going to evaluate the work in progress inventory? The work in progress inventory is evaluated by including the direct manufacturing labor costs as well as other overheads into the raw material cost. Let me explain how does this happen. So the thing is, once you are done evaluating the raw material, to evaluate the work in progress inventory, you consider that you have spent around $50,000 in direct labor as well as $50,000 in other overheads. That indicates that at the end of the year, you have $100,000 plus $50,000 plus $50,000, that is $200,000 worth of work in progress inventory. But out of that $200,000 work in progress inventory, 90% you have converted into finished goods. That means 90% of $200,000, that is $180,000 is the cost of goods manufactured, COGM, because that has been converted into finished goods. Whereas what's remaining, that is around $20,000, will be considered as an inventory of work in progress kind. I hope you have understood the concept till here. Going further, imagine that you have sold only half of those finished goods during the year. So, at the end of the year, your inventory in the form of finished goods will be $90,000. So, this is what is the inventory total at the end of the year with you. $20,000 worth of raw material inventory, $20,000 worth of work in progress inventory, and $90,000 worth of finished goods inventory. This goes into balance sheet. Whereas this figure, that is $90,000, half of what you have completely produced, goes into COGS. And here is the relationship, that is, whatever revenue you have generated over the last 1 year by selling these products, that comes over here, subtracting COGS from that revenue will give you the gross margin. And this is how it comes in P&L statement, whereas the things that are on the left side of the screen goes into balance sheet, that is inventories, this one as well as this one. I hope this block diagram could help you to understand how balance sheet and P&L statement are bound together in the case of inventory. Moving further, I want to finish this particular lecture with one explanation. That is inventory an asset? Yes, it is. Then more of it is better for the company, right? No, it is not so. Why? Because inventory can go obsolete. So imagine that you are a mobile phone manufacturing company. You have manufactured thousands and thousands of handsets, hoping that you would sell them. But suppose your competitor came with a better model and your inventory remains as an inventory, as an asset, but it will not be sold. It won't turn into COGS. And because of that, this obsolete inventory will turn into a problem for your company. Though in the records, in the financial books, it would look like an asset. This is the first, probably the difference which you can see between the books and the actual situation that happens on the ground in case of inventory. Second concern because of inventory, a lot of inventory, is that it needs a lot of money. It requires a lot of money to maintain the inventory. Probably if you have inventory that needs certain temperature or relative humidity requirements, or probably you need a lot of manpower to handle the warehouse in which you are maintaining the inventory. There are multiple costs that are relevant to inventory. Also, whatever inventory that you have lying in your company, in your godown, that inventory is nothing but money that is remaining in the form of inventory. And that money costs you rate of interest. That is, if you wouldn't have had that inventory and immediately after manufacturing, if you would have sold it, that money that is stuck in your godown won't have remained so. So I hope you have understood how a lot of asset is also not good for a company. In fact, a asset heavy company is never considered to be a good company. Thank you.